Somewhere in America today, a bank will approve a $400,000 mortgage. Here is what it will not do. It will not go to a vault, and it will not take the money out of anyone's savings. It will type a brand new $400,000 deposit into the buyer's account, money that did not exist 1 second earlier. And the money supply of the United States just grew.
That sounds like a conspiracy theory. It is the official description of how money works. In 2014, the Bank of England published a paper called Money Creation in the Modern Economy and spelled it out in one sentence. Whenever a bank makes a loan, it simultaneously creates a matching deposit in the borrower's bank account, thereby creating new money. Most of the money you had ever earned, saved, or spent was born exactly this way.
Here is the mechanism, drawn slowly. A bank's balance sheet has two sides. Assets, what the bank owns. Liabilities, what the bank owes. When the bank approves the mortgage, it writes the loan on the asset side. The borrower now owes the bank $400,000. In the same instant, it credits the borrower's account on the liability side. The bank now owes the borrower $400,000. Two entries, one keystroke, and the deposit is real spendable money. Because that is all a bank deposit is, a number the bank owes you, an IOU you can spend.
When the buyer wires that money to the seller, who banks somewhere else, the deposit simply moves to the seller's bank. Behind the scenes, the two banks settle up with a special kind of money called reserves, accounts that banks themselves keep at the Federal Reserve. The total out in the economy does not change. The money was created at the moment of the loan, and it is still out there, circulating.
Now, zoom out, because the scale is the part nobody tells you. Add up all the money Americans can readily spend. Every checking account, every savings account, every bill and coin. Economists call that total M2. And in May of 2026, it hit a record, just over $23 trillion. How much of that is physical cash? About $2.4 trillion, roughly $1.10. And the Federal Reserve estimates that roughly half of all U.S. banknotes are not even in the country. So the money everyone pictures, the green paper, comes to around 5% of American money. Nearly everything else is bank deposits, numbers typed into existence one loan at a time.
The printing presses are real, by the way. The Bureau of Engraving and Printing runs off several billion notes a year, but most of those replace worn-out bills already in circulation. The machine everyone pictures making America's money is mostly a maintenance department.
And here is the stranger half of the story. Repayment runs the machine in reverse. At today's rates, about 6.5%, the payment on that $400,000 mortgage is around $2,500 a month. Most of that, at first, is interest. That part is simply the bank's income. But the few $100s of principal does something almost nobody realizes. It cancels against the loan and it vanishes. Money deleted. Every month, across the whole economy, old loans being paid down destroy money the same way new loans create it.
If you ever took an economics class, you may have learned a different story. The money multiplier. Someone deposits $1,000, the bank keeps 10% in reserve and lends out $900. The $900 gets redeposited and relent, and so on down the chain. Tidy, intuitive, and according to the central banks themselves, backwards. The Bank of England put it in writing, not an accurate description of how money is created in reality. Banks do not wait for your deposit and lend it out. The lending comes first. The deposits are created by it. And if you want proof of how dead the old story is, in March 2020, the Federal Reserve cut the reserve requirement, that 10% from the textbook, to 0%. It has been zero ever since. The number the whole textbook chain was built on is zero.
So if money is a keystroke and no reserve ratio stops the typing, why don't banks just create infinite money? 3 breaks. First,
the loan has to be worth making. Banks only profit if borrowers actually repay with interest. Reckless typing becomes bad loans, and bad loans eat the bank. Second, capital rules. Regulators require every new loan to be backed by a slice of the bank's own shareholders' money, and that caps how far any balance sheet can stretch. And third, the biggest break of all, the price. The Federal Reserve sets the base interest rate for the whole system, right now between 3.5% and 3.75%, a range it held again in June at the first meeting chaired by its new chairman, Kevin Warsh. Raise the price of borrowing, and fewer loans make sense, so less money gets created. Lower it, and the typing speeds up. That is what a central bank actually controls. Not the quantity of money directly, but the price of creating it.
You can watch this machine run at full throttle exactly once in living memory. 2020. The pandemic hit and everything opened at once. Stimulus payments, emergency lending, the Fed buying trillions in bonds. Look at what the money supply did. In the 12 months to February 2021, M2 grew almost 27%. Nothing close to it appears anywhere else in the Fed's modern records. Then, through 2021 and 2022, came the worst inflation in 40 years. Did the money surge cause it? That is still a genuine fight. Some economists, including at the Fed's own regional banks, read the inflation as a delayed effect of the money growth. Others put more weight on snarled supply chains, energy prices, and the spending programs themselves. The sequence is not in dispute. The surge came first, the inflation followed, but how much of the blame the money itself carries is still being argued in public.
Which leaves the oldest question in banking. Who gets to do this? 300 years ago, London goldsmiths took in gold for safekeeping and handed out paper receipts. The receipts started changing hands as money, and the goldsmiths noticed they could issue more promises than they had gold. Private money, created by private hands. Until governments moved in to charter and control it. That fight never really ended. It just changes costumes. The newest costume is the stablecoin, a digital token pegged 1-to-1 to the dollar. There are about $310 billion of them circulating right now. And last year, Congress passed the Genius Act to decide who may issue them and what has to sit behind them. The rulebook is late. Regulators just missed their July deadline, and the final rules are still unwritten. But the intended deal is the opposite of banking. A stablecoin issuer is supposed to hold $1 worth of permitted reserves for every token it mints. No typing money into existence. Whether that line holds, whether the dollar's next form is fully backed or quietly becomes the goldsmith's receipt all over again, is being decided in Washington right now.
So the next time you open your banking app, know what you are actually looking at. Not cash in a vault, a number your bank owes you, and almost certainly a number that was born the day someone, somewhere, signed a loan. America's money is not mostly printed. It is promised into existence, and it is destroyed by keeping the promise. That is the machine. Now you have seen it drawn.